We've seen a very bad September in terms of deals, both the sort of outright volume of deals, but also no big deals, nothing. We were talking about just before we came on air, we can't even think of the biggest deal that we had this month or last. Should we be worried?
Look, I think that September is really an acceleration of what we've seen in most of the quarter. And really what you're seeing is, anytime you evaluate what deal activity is and whether you should be seeing a lot of it, it's really a confluence of a lot of factors. Some favor M&A, some against M&A. I think what we saw in 2018 in the very early part of this year was those factors were tilted in favor of deal activity. I think what you've seen in the third quarter is probably some of the factors that favor M&A have continued. Buoyant stock prices until at least the last few days, and cheap debt from the low interest rates. But I think what you've seen is a development of factors that are steepening the hill for M&A activity. Most of those are in sort of the geopolitical variety. You have what's going on in Iran and the Saudis. You have Brexit. You have the impeachment in Washington. And you also have a recessionary tilt globally, which is starting to affect the U.S. economy. And I think what that's doing is it's shifted the tide a little bit against M&A activity. And the challenge when you say, should we be worried and should we be looking ahead, one of the concerns you definitely have is that it's not apparent that any of those uncertainties are going to clear themselves up in the near term. You look at that list of factors, it's hard to see any of them resolving very quickly or favorably in the near term. So I think there is going to be that steep hill that's going to still need to be climbed in order to get back to that level of M&A activity.
Okay, but this is super interesting because one thing that is obviously key to any deal, particularly a big deal, particularly any deal cross-border, is confidence. You need real confidence you're going to be able to get the thing closed. And that is already impaired because you have the activists jumping into a lot of deals, a lot more than we've ever seen before, as a mechanism for actually making their case, because they've run out of vanilla options, if you like, as just normal stocks. How does that impair and indeed impact the ability to get deals done?
Yeah, no, absolutely. I think historically the way that activists have gotten involved in M&A activity is actually generating M&A activity, because push, jump in, spin off a piece of the business, sell a piece of the business, sell the company. I think when you have the M&A market and the capital markets conspiring against those events, activists have to look for a new outlet because their returns depend on generating an event that creates an upside opportunity for them in the stock. And I think that's why we've seen the first half of this year, and I think it's continuing into the third quarter, record levels of activists jumping in to disrupt an announced deal, whether it's on the sell side to try to push the price higher. We call that bump arbitrage. We've also seen it on the buy side where activists have jumped in and tried to block a buyer from doing a deal in order to force the buyer to sell itself.
Myers, notably where you guys represented Bristol on the defense and actually successfully won against Starboard in that campaign. One thing that always occurs to me, and we don't talk about this enough, is what is the legacy for those companies that do have an activist come in, they do fight, sometimes they win the fight, sometimes they lose a fight, but we never then go and look back at those companies and say, well, what damage does it do long term?
Absolutely. I think the activist can always collect its chips, go home, and move on to their next opportunity. The company's left to clean up the mess. And as you said, whether they win or lose, there's major damage and broken glass that they have to clean up. And you have a management team and a board of directors that was solely focused on this activist situation for months at the expense of everything else that you would hope that a management team and board could focus on. And then an activist comes in and says, sell the company. Great. You put the company up for sale either publicly or privately, and then it doesn't happen. Once again, the activist sells his stock often before the stock even drops when it's clear that there's not going to be a deal. And then the company's left with the legacy of the fact that they weren't able to execute a deal. No one showed up to the party that the activists forced them to throw. And then the company has to, again, put itself back on footing. You had a company that was forced to think about itself as sale bait for a whole bunch of months and now has to go back to trying to run its business. So undoubtedly, I think the damage that an activist can do is not just limited to the activist situation itself, it's cleaning up the mess that they leave.
Okay, so I want to synthesize. If I factor all of these things in, the geopolitical risks, the closing risks, the damage that activists can do, it doesn't seem like a particularly positive note on which to go into a market next year.
Absolutely. I think that what you're seeing is when a board or a management team is sitting down and thinking, is this the time I want to take a risk, a transformational risk? It's just not, sort of, as you said, confidence is the word, and I think all these things weighing against it is really going to constrain that activity for the next year. And I think we always think about also heading into an election year where that you have that additional risk heading in and uncertainty, that acts as an additional constraint. So yeah, I think there's going to be some leveling off or drop of activity probably for the fourth quarter and into next year.